the decisions have consequences. Where you choose to invest your money has an impact in the world.
Kia ora and welcome to Money and You, an initiative of the Financial Services Council that aims to grow your financial confidence and well-being. Now, you might take your reusable bags to Countdown, you might drink your coffee from a keep cup, maybe you're really good at sorting your recycling and reducing your meat intake. But did you know that you can also take some action when it comes to your money? We're not just talking about buying secondhand clothes or perhaps purchasing local and sustainable produce, while those are also really great things to do. Today, we're talking about your investments, where you put your money, and KiwiSaver, your retirement savings, is a really big part of that. So this episode is going to be all about responsible investing, and you might have heard some other terms used like sustainable investing or ethical investing, and I'm going to ask our guest to explain some of these terms today. But basically, we're going to look at what it is, how you can get started if it is something that you're interested in, and what to look for. So nothing our guests are going to say today is financial advice. I'll just be very clear from the outset that we're just going to give some very general information. If responsible investing is something that you want to look into and learn more about, then we encourage you to do your own research and also seek advice from a professional financial advisor. So without further ado, I'll get into introducing our guest for the episode. With us today, Barry Coates, the CEO of Mindful Money, a charity that aims to empower Kiwis to be responsible in the way they invest their savings. And we also have Shane Solly, who is a portfolio manager at Harbour Asset Management. And both Shane and Barry have been in this responsible investing space for what I understand to be many, many years. And I am so privileged to be able to chat to both of you today about this topic. Kia ora and welcome to Money and You.
Kia ora.
Kia ora.
All right. So let's perhaps just start with a bit of a definition of responsible investing. I know there's a lot of terms thrown around. There's impact investing, sustainable investing, responsible investing. Are these all the same thing? What are we actually talking about with all these terms?
Thanks for inviting us on, Clarissa, and it's great that Financial Services Council is doing this series. So congratulations on it. So there's a whole lot of terms around on this. So it used to be called primarily ethical investing, and for many years it was used in kind of the anti-slavery movement, for example, to boycott the companies that finance the slave trade, or is used in the anti-apartheid movement against South Africa's apartheid, and in many other cases. So for many years, it was very much a kind of a niche sector. And then I guess just over the last 15 to 20 years, it's become far more mainstream. And there's a few different variants of it. When it's used in the financial sector, it tends to be called responsible investing. And there are various flavors of that. It's sometimes called green investing. But that area around ethical, responsible, and to some extent sustainable investing is kind of often interchangeable terms. Mindful Money uses ethical investing because that's what the public understands. And so we tend to talk about that, but very often we're talking about exactly the same thing. And we'll come back to what strategies there are that underlie these terms. But there's one difference, which is impact investing is generally a more defined term around investing with a positive social and environmental outcome. So you could say ethical or responsible investment is taking social and environmental issues into account in your investing. Impact investing is when you invest for positive change. And so that tends to be where the definitions sit. But Shane, feel free to jump in.
Yeah, thanks, Barry. I think it's a fabulous question, and what we know is that this is an evolving thinking. So when 20 years ago, when I first started out as portfolio manager, managing funds for what were predominantly ethical investors, they were faith-based. There were certain things they had real concerns about investing in, and this has evolved to what we now call responsible investing, which is all about improving outcomes environmentally, socially, for society, at the same time as delivering really, good returns to investors. It's still a crucial part of it all. And so there's a little bit about directing capital to businesses or investments that do better things, but importantly about directing capital away from businesses that do poor things or investments that do poor things. And I think one of the amazing things about finance and investing is we touch on so many different parts of the economy, sectors and industries. In fact, there's no real business or commercial activity or governments, even Barry, semi-governments, where investors can't actually influence outcomes by directing their capital. We've got this amazing ability to actually instigate meaningful change over time by directing capital. But I think it is a case where don't get anxious about the terms. It's more about a really good opportunity to do a bit of digging around and understand what the different terms mean, and find the term or the style that really works for you, the one that really means more to you.
We're talking about investors, and it just occurred to me that, there's probably a lot of people, a lot of Kiwis out there who probably don't consider themselves to be investors. But actually, a lot of us are investors through KiwiSaver, our retirement savings. When you invest your money, whether it's in KiwiSaver or perhaps, you do have other investments like managed funds, for example, that money, where is it actually invested in, and how can you find out that information if you're interested in knowing what kind of industries or companies you are investing in?
Yeah, look, it's amazing. The number of New Zealanders that we actually own bits of the government, we own bits of the businesses, we own bits of this amazing technology that drives our economy, because we're all KiwiSaver, or predominantly KiwiSaver investors. And so when you invest your money in your KiwiSaver, and you are doing that, it's about putting capital away for the future so that you've got capital available for when you're not working, or when you just want to settle down and live life a bit more relaxed. That's what it's there for. That's what those funds are there. And the funds invest in companies that are listed on the stock market. They're invested in debt securities, or what's often called fixed interest securities, that are issued by governments, semi-governments, things like councils, and by companies. They're invested in things that are like commercial property, private equity, venture capital, which they're not listed on the stock market, but they still direct capital into delivering economic outcomes. And funds also hold cash reserves. And I think what we need to understand is that is how we can all influence as individuals outcomes for society. What are those businesses doing with their money? I want a good return, but I also want to get a good outcome for society. The best place to find out about what funds are actually doing, going on the website of the funds you're in, having a look at their fund disclosure statements. It's a little bit of work. Alternatively, going and having a look on amazing platforms like Barry's Mindful Money, who does a lot of the work, weeds through this and really clarifies what different funds are doing. So I think it does require a little bit of homework. It's well worth it though. You get a lot more comfort, a lot more positiveness about what you're doing.
Thanks, Shane. That's a very basic question, Clarissa. We get so many people who say, I've got a KiwiSaver and I have no idea what I'm invested in. And so we used to get that question all the time. And it's one of the reasons that I set up Mindful Money. So we're an independent charity, And we exist to help people understand where their money goes and to be empowered to make decisions around where their money goes. Because, once upon a time, you used to get a KiwiSaver and you see all of this information around, financial return, this and who's running it and so on. You'd never hear about where your money goes. And people do kind of realize money has consequences. So if you invest in a company that's producing nuclear weapons, then, many people are appalled by that. But, we did research that found out that $100 million of KiwiSaver money was invested in companies that make nuclear weapons. As a kind of a country that is against nuclear weapons, that's kind of shocking. I mean, the good news is we went back to those funds and said, do you realize what you're investing in and why don't you get out of these things? And over time, that's now down to only a few $1 million. So there's been a huge shift. Similarly, there's been a huge shift of money out of fossil fuels. It's been a huge shift of money, of course, out of tobacco and things like that. So what we see is that people do want to know where their money is invested. And what Mindful Money does is we unpick all of the portfolios, all of the KiwiSaver funds and all of the investment funds, not only what they directly invest in, but also what they indirectly invest in. And we show it to people on a website. And we show it in terms of categories that correspond to things that Kiwis are concerned about. So we do annual surveys of the public and say, what do you care about? And people say, well, I'm worried about human rights violations. I'm worried about slave labor or child labor in my supply chains. I'm worried about animal welfare issues and products tested on animals. I'm worried about issues like gambling and pornography and alcohol and tobacco, so what we call the sin stocks. Increasingly, they're worried about fossil fuels, worried about GMOs, worried about palm oil. And so what we do is we tell people basically where their money is, which companies and how much of their money is invested for all of their portfolio. We try and make it really simple for people to see that. And as we say, we do the research so that you don't have to. We can provide that information. But it is a really fundamental question that everyone should be asking to say, where's my money going? And we should be aware that these decisions, as you've said and as Shane said, the decisions have consequences. Where you choose to invest your money has an impact in the world.
You mentioned before that there are, several different strategies that funds can take when it comes to responsible investing. And I'm wondering if you could maybe break down what some of those are for people.
My job day to day is actually implementing, actually investing for funds. And there are many different platforms, ways of doing it. But the three main ways that people think about responsible investing is exclusion, integration, or impact investing. And we touched on this earlier on. And they're all subtle differences. And they all have differing outcomes. So exclusion is just that. It restricts the investments into assets and securities that are considered to be irresponsible. A good example would be not investing in a business that has a poor environmental practice or that contributes to social injustice or suffering. And you might think that's, why would you do that anyway? Well, unfortunately, the market is that, or the investment universe that we have to invest KiwiSaver funds in or general funds in, includes some businesses and some assets that actually contribute to that. So exclusion is rules-based. It says that particular investment is removed, you can't invest in it. And it's more traditional, it's what we've seen in the long run. And so I think, a good example is we've gone through, we've ranked all the companies. This company has a very high carbon footprint. You cannot invest in it. Integration goes another level, and it says we want to directly invest in securities that are improving their environmental or social governance or ESG rankings and standards. We want to invest in companies with improving rankings, but we also want to work with the security issuers, who's issuing the stocks and the bonds and the other things that we invest in. We want to work with those companies to improve ESG outcomes. It's a far more active approach than exclusions. And a good example might be investing in a company that is going through an energy transition. We know there's companies that perhaps have quite high carbon footprints, and really engaging with those companies and saying, we need you to lift your game, get rid of that dirty coal-fired electricity generation, find a better solution. Otherwise, as Barry talked about earlier, we're going to move the capital somewhere else. We're going to make it harder for you to do your business. Right? This is how we really act. So this is why, as a KiwiSaver investor or a fund investor, you can really influence outcomes, not straight away, but over time. And then I think finally, impact investing, as Barry says, specifically related to really constructive positive outcomes, often related to what's known as the United Nations Principles of Responsible Investing, Sustainable Development Goals. There's a lot of words there, UNPRI, SDG, and I really advocate for people to go and have a look. And this is things like, I want to deliver much better healthcare outcomes for people, and supporting businesses or entities that are all about delivering those better outcomes. And then as an investor, I get a reward. Look, there's some other twists that are coming through that are a bit more technical, if you like. We're actually seeing some funds specifically going out and saying, that company's doing bad things, they're not changing, we're going to do what's called short selling. And I won't go into too much complication other than it's where I borrow from somebody else, I sell the stock on the basis the stock value is going to go down. A good example is an Australian electricity generator who burns coal, right? Brown coal, massive impact on the environment. That's the stock that's not going to do well. We can make money out of that. That's ultimately what it says. Barry, I'll let you add some points to that, but those are the key ones, right?
Yeah, no, absolutely. So just a few quick examples. So, and it should be said that these are not choices in terms of the strategy. We do annual awards, and last year the awards showed that the best funds are doing some of each of these different strategies, because if you think about it, what you want to do is you want to exclude the worst companies, because they're not the companies that are going to change. And for many people, that's excluding fossil fuel companies these days, because fossil fuel companies are very much part of the problem, and very few of them are actually really part of the renewable energy solution. So many people just say, I want out of fossil fuels, and the proportion of KiwiSaver funds in fossil fuels has gone down, but there's still $1.5 billion of KiwiSaver funds in companies that produce fossil fuels. The number of funds, the proportion of funds that have gone fossil free, excluding fossil fuels, has increased from 2% to 19% over the past 2 years. It's a huge increase, and we've got on our website a listing of all of those funds that go fossil free. So that's the kind of the exclusion thing. And then, as Shane said, there are some companies that couldn't be persuaded to do the right thing and can be persuaded to change, and they ought to be supported by investors. And that's the whole sort of engagement thing, where you use your money to push companies to go further. And that's really worthwhile doing, where companies are willing to make those changes. And then finally, as Shane said, you can go into the impact area. And in New Zealand, there are a few good examples of that. Mindful Money is setting up a directory, which we're launching next week, of impact funds that people can, because we have a lot of people saying, where can I find about these impact funds? And so finally, we're setting up a directory of them. There are very few that are available to retail investors, i.e. to the normal public investors. There are a wider range that are available to the wholesale or kind of qualifying investors. But we've got all of those that are coming out next week. So I guess just to say the last thing about it is stuff really makes a difference. And if you look at the impacts, for example, of the companies that get boycotted or don't have funds anymore, their share price goes down, their cost of capital rises, and they lose out compared to the companies that are doing better things. So the fossil fuel companies, for example, if you look at their returns over the past 10 years, they've been shockingly bad returns. And it's at least partly because there's $40 trillion worldwide of funds under management that have excluded those fossil fuel companies. So it has a real impact on companies, as does good engagement where shareholders get together. It's a great case recently of even ExxonMobil, which most people love to hate as a big fossil fuel company. 3 of their directors got kicked out by active investors. And it was a great story because the active investors kind of basically got sick of the company saying, oh, yes, we're going to change. And of course, they never did. And so they removed 3 of the directors. And that's a great example of investors starting to flex their muscles to say, even the biggest companies, well, Exxon is no longer the world's biggest company by far, but it used to be. And, but even these huge companies can be influenced by investors. So it does make a difference.
Barry's bang on. This is we're getting this amazing wave of change. The companies are really waking up and going, how can we improve things? So they're actually reaching out and saying, what do we need to do? And I hate to say it, it's like, this doesn't stop. There's another thing. And then we, as an investment community, this is our role, is to try and, this is the next thing you need to work on. Here's your current target, keep going. Don't stop there. But yeah, I think, come back to, is it actually having an influence on outcomes? You bet. So I think we can all see there's a great momentum, and the amount of capital searching the world to invest in good companies and bonds and other investments that have high quality ESG credentials or responsible investment, it's just growing. It's massive, and it's just growing by the day.
So many people who were tapped into what happened around the climate summit, COP26, would have heard about this big net zero movement. And some of the largest fund managers around the world are part of declaring that they're going to reduce the emissions of companies that are in their portfolio to zero by 2050. So that means persuading those companies to get out of emissions, or for the remaining emissions they can't get out of, to offset those. But the emphasis is on reducing emissions. So if you do that throughout your whole portfolio, then you can go on a pathway to net zero. And recently, the government superannuation fund, our big super fund that has $60 billion under assets, they have declared that they're going to net zero. And before that summit in Glasgow, we set up a coalition to try to encourage funds to go to zero. And lots of New Zealand funds are on that pathway now to head towards net zero emissions. So how is that important to investors? Well, as you said in your introduction, we all think about what we can do for recycling and taking our bags along to supermarkets and switching off electricity and so on. But actually, an even larger proportion of our kind of carbon footprint, our climate footprint, is involved in our investment. So we did a calculation to say, for the average KiwiSaver fund, it's around 3.4 tonnes per person on our emissions. And that's huge. Our total emissions aside from that, it's only around 7.5 tonnes. So this is just from our investment, and people can manage it down by selecting the right funds and selecting the the kind of the ethical or responsible investment managers that are going to reduce their emissions down to zero. And it's a huge change. As Shane said, this is one of the next changes that is really sweeping through the way that people think about investment, because they think now about how can investment be useful to get to net zero. So far from being part of the problem, which frankly finance has been in the past, finance can start to become part of the solution.
I noticed too with the changes to the default KiwiSaver funds that kicked off very recently, there seems to be more of a consideration of how responsible these default KiwiSaver funds are, I suppose. And yeah, just wondering if you could talk a bit about that, because it feels like that's a big shift, and that's sort of a message going, yes, this is sort of the way forward.
Yeah, we did some lobbying on that to try and make them fossil free, so no investment in fossil fuels, and the government adopted that, or with a few loopholes, but largely adopted that. And so each of the default funds now isn't allowed to invest in most fossil fuel companies, and isn't allowed to invest in nuclear weapons manufacturers. So that's a really kind of important point. So in a way, for many of the fund managers, they kind of figure, well, if my default fund is excluding fossil fuels, then maybe I should extend that to other funds as well. So that is helping to change the industry as well. I don't know if you've seen that, Shane, in your dealings with fund managers.
Yeah, look, again, I'm at the workbench, if you like, of actually implementing portfolios, and certainly we spend a lot of time making sure the investments we make for our investors, our clients, are not exposed to some of the areas Barry's touched on. But it really runs deep. There is a lot of different areas we have to think about. Things like modern slavery are a very real risk in many businesses. And if you think about it, every time I buy a garment, I want to know that there's not a child labor component in that garment. And unfortunately, historically, there has been. I want to know that there is, as Barry said, in commerce, we unfortunately do generate carbon and heat. And what do we do? What's the offset? How can we reduce that? Things like, what's the refrigerant being used at an office tower? You go, what? How you get that granular? Yeah, we do. We get right down to the nitty gritty. I want to know what this gas does not contribute to greenhouse gas emissions. It's things like gender balance on boards, making sure there's an equal number of men and women and others on boards to be representative of society. And you can go, really, it makes a difference, makes a huge difference. And I can say it because it actually makes an economic difference too. We know from our research that where you've got a balanced board, you tend to have businesses that deliver better outcomes. So there's a lot of things to think about. Some of these things people can sort of go, it's a bit of a stretch, but it actually makes a difference. And so I think, Barry, it's not one thing, right? It's an and. Yeah. And we just got to keep thinking about how we do. And so there's these new default providers. Firstly, nobody goes out there to be an irresponsible manager. So it's really sort of notching things up another level. So it's great. It's the way we need. And I think one of the things that we also got to recognise is when, as fund investors here in New Zealand, whether it's a KiwiSaver or explicit funds, when we go overseas, we do actually face companies. We don't have many or any companies in New Zealand that have a nuclear component to them. Very few fossil fuels. But as soon as you start going outside of New Zealand, there's a heck of a lot of potential risks. And that's where it becomes very real.
Now, I want to ask you about returns and touch on this discussion. there's been, there's often a bit of debate around this when it comes to responsible investing. I know there's people out there that sort of say, oh, well, if I want to invest responsibly, then I'm going to give up some of my returns, and I just wanted to ask you about that. Is there a trade-off between investing responsibly and getting good long-term returns on your money? Like, how do responsible investments tend to perform in relation to funds that perhaps aren't as responsible or are focused on those issues?
There's now quite a lot of long-term evidence on this, and there have been so it's called meta studies, so studies of studies across thousands of different studies, and the conclusion comes back pretty strongly that overall, and the terminology is usually if you invest ethically, your returns are at least as high, if not higher, than on conventional funds. So it skews on the higher returns. Other people have put it more strongly and say they produce higher returns, and that is substantial evidence around here. So that comes from the many of the things that Shane talked about in terms of good company practice, but I think most people could understand it. In New Zealand, the most sustainable companies tend to be those companies that are best trusted. Their consumers like them. They have good brand reputation and good customer loyalty. They don't get sued for environmental liabilities. They're able to attract the best employees who are really motivated to work for that company. There are so many ways in which the kind of the high sustainability companies have a kind of virtual circle which results in higher returns. They also have less risk because they're not incurring some of those risks of the same risks of climate change that other funds are, or of risk to their corporate reputation. That then reduces their risks as well as potentially increasing their returns. And that's where you get that skew to higher returns from overall. And that's, as I say, that's been proven by a lot of academic study. And closer to home, the super fund, when they excluded fossil fuels, said, we're not sure beforehand, we're not sure, what the impact is on returns. And it turned out that they had saved the New Zealand taxpayer $800 million in terms of higher returns by excluding those fossil fuel companies. And similarly, Simplicity, when they went to their fossil-free policy, did the same thing. So very often what we're seeing is doing the right thing is also doing the good thing. And the guy who's CEO of the world's largest asset manager, a company called BlackRock, put it like this. He said the question used to be, why invest ethically? And now the question is, why not? Because you do good things and you get better returns. Why not? And it seems like a very valid question to ask.
Yeah, because so we would just say responsible investing is just good business. Our research and our long-term actual outcomes for investors show that investing for good is actually really good investing. Our best performing funds are often the responsible investing funds. So integrating these responsible investing approach, it not only delivers these higher returns, but it's actually the risk. So we don't get these dips or these negative periods of performance. And particularly if you're investing in a fund for a period of time, that's actually really important. Not losing money is a pretty helpful thing, right? It's like, that's what it's all about. We want to grow it, but we don't want to lose it. And what we find is that when we integrate the ESG considerations, it's a really extended due diligence process. So I'm highlighting investments where there's more risk, and where I can say we can weed that investment out. It's not going to sustain the returns, and actually focus that into other investments that have a better return. So better guardians of capital. And Barry's entirely right. We know from our research that companies with good governance and good environmental and social tend to be more consistent performers. So I don't think there's an impost. I don't think there's a cost associated with good responsible investing. It is often associated with really innovative businesses that have attractive long-term growth paths. So it's not just about avoiding the bad stuff, it's actually pushing this really exciting stuff. So I just think, it is, from our point of view as a manager, it's a bit more work. We have to spend a lot more time digging around, making sure companies aren't just saying things and not doing them. But you know what? The rewards are massive. It is a far more, it is a better outcome for returns relative to risk. And it is much more powerful as an investor to be supporting good outcomes. So, yeah, I agree with the view that, why wouldn't you?
All right. I think we'll finish up with one final question for each of you. I'm wondering if you could share some tips or some small steps that people can take if they want to start making some more responsible choices when it comes to their investments, whether that is with their KiwiSaver or other investments that they might have. What tips would you have to get started?
I hate to say it's a little bit of homework. Understanding how the funds you invest in actually manage their funds. Getting comfort with what actually goes on behind the scenes. It's not a lot of work. Sometimes it's just a one page. You just have to read, what they do, how they do it, and what that means for the ups and downs. I think there's a lot of challenges for people to cut through some of the marketing noise and actually really get behind the spin and say, I understand the risks and the rewards. I think, there are concerns that there's some checklisting going on. It doesn't always deliver the best outcomes. It's a good start, but, really, in our view, we've got to engage. I think, certainly using, fantastic platforms like Barry. Sorry, Barry, I'm heaping praise, but it is true. It is a very great, it's a really good resource for people to start their journey and build their journey is to look at that. So it's a little bit of homework. It's actually fun, by the way. I'm sort of channeling my inner geek saying it's fun, but it's fun. But it is good. And I think, everybody can learn a little bit from it, feel a lot happier about what they're doing.
Yeah, I think a lot of people feel disempowered when it comes to financial choices and financial information, and they think it's all too complicated. And so a lot of people put on their to-do list. And we used to have a question of, how long has it been on your New Year's resolution list to change your KiwiSaver? And for a lot of people, it's on there for at least a decade on their New Year's resolutions. But it doesn't have to be so complicated. And that I think that's something that sort of Shane and I would agree on. You can just get started. And in a way, it's why we set up Mindful Money is kind of to make it easy for people. And we get people coming to us and saying, I spent a quarter of an hour on your website and I understood where my money is going and I was able to make a choice. And so it doesn't need a degree in finance. It doesn't need you to put away sort of a week of your life in looking through every single book or every single website. For people should feel like they can get the information and act on it. You need to ask a financial advisor if you've got particular circumstances that are really tricky or where your own kind of personal circumstances need advice. For many other people, it's going to be a lot more straightforward, and it's going to be around which KiwiSaver do I want, or which investment fund do I want, and so on. That's a much easier set of choices, and you can go to Mindful Money or other websites like Sorted in order to get that information. But the kind of encouragement to people is don't put it on your New Year's resolution list for 2021. You can kind of knock it off now and get on and do it, because so many people are doing it now. As Shane knows, there's been such a huge shift of New Zealand investors into ethical and responsible investing, and we get these people coming to us all the time saying, thank you so much for making it easy. We're earning good returns. We feel happy about our investment. We know it's doing good. We know it's avoiding bad companies. And that stuff isn't so difficult, isn't so complex. So it's kind of a little bit of an empowerment message, get on and do it.
I'd also suggest that people reach out to their funds that they're in and say, hey, can you just give us some information, please? And you'll find there's a wealth of information. And certainly I think there's a lot more easier descriptions used in documents now. It's not the financial gobbledygook. It is much more cleaner and transparent. So please ask. It's an interesting process, and I think people will enjoy it if they get involved.
Some great tips there. Thank you so much, Shane and Barry, for your time today. I definitely learned a lot about this topic, and I'm sure everyone watching did as well. Thank you very much for joining us on Money and You.
Thanks for having us on the show, Clarissa.
Thanks, Clarissa.
Thanks, Shane.
See you, Barry.